Welcome back to Real Estate Mindset and good morning. Happy Tuesday. Sorry if there was a little bit of a delay. You guys, this is my very last live broadcast from this studio. As you guys know, I am forced to move out of my house. That's why I'm starting this a little bit early today, because as soon as I'm done recording this, I have to get back to moving. You guys know that I did re-sign a 1-year lease, so I'm going to be on the sideline for about a year at least. And also, guys, my entire family right now is on Z-Packs. So I'm kind of like a one-man army right now, as far as, having to move. But I had to do one more live video, you guys, because again, this is the last of the studio. This is where Real Estate Mindset was birthed. This is where it all began. So it's a little bit, bittersweet for me. I'm going to miss this studio. I'm not going to miss the mold in the house. I'm definitely not going to miss the landlord, who is extremely cheap and treats us like garbage. But either way, you guys, this is going to be a great video. I kind of went above and beyond, and I'm going to show you guys a lot of buying techniques, what to look out for, stuff behind the scenes, things like that. So you guys are going to get a real good update today, real good live today. I wanted to say good morning, though, to Guz, Volvo. Appreciate you. There's my buddy Maverick. Hopefully you're staying strong, Maverick. I see you stressed a little bit, brother. I don't like to see you like that. I want to see you strong. I see you in the comment section, brother. Night Cry, I love you, man. It's always nice to see you, brother. I want you to continue to stay strong. There's my buddy Dean. Dean, nice to see you. And there is my boy. There's my man Jeff right here, or we like to call him Arms, because he has big arms. CR, good morning. Thank you for your concern, brother. I appreciate you. I'm just digging deep and moving all by myself. It's cool. Bluebird, is that you, Shipley? I don't know. Is that you, Shipley? But good morning to you. Good morning, Peter. Sideline. There's a girl, Christy. Christy's frustrated. She's waiting for those price declines in Austin. She's a little bit on the higher end, Austin, but she's got a lot of good intel. Christy, appreciate you. Always nice to see you in Discord as well. Always uplifting people. Definitely appreciate it. Good morning. Good morning as well. P Nice. There's P Nice. There's living in Omaha. Living in Omaha, it's always nice to see you, brother. I'm really happy that you can be here to learn. You don't get offended. Hopefully, living in Omaha, tell us in below, but, are you learning stuff from these videos and for these lives? And are you taking what you learn and are you helping your customers? I want to know, man, are you growing from these lives? That's why I do that, right? It takes a lot more effort, a lot more time to do the lives, but I definitely do it to really touch you guys, to be a stronger part of the community and to make a bigger impact and a bigger difference. Good morning. I'm kind of taking my time because this is my last live. Okay. I'm really kind of sad, actually. Trey, there's my buddy Trey. Trey, I love you, brother. Always thinking about you, Trey. Hopefully you're doing well, man. Hopefully you got through that situation that we've been talking about. Good morning. Good morning. Well, we're going to get started right now, you guys, just so people don't get mad at me. But what we're going to do, guys, is we're going to start our mortgage update right now. And again, I'm going to give you guys a wealth of information. We're going to cover all kinds of stuff today. And where I'm going to start, guys, we're going to look at the 10-year. We're going to look at mortgage rates. But as consumers and as citizens, we have to remember, okay? So, sorry about that. So when we go to purchase a home, remember what's really important. And I'm going to ask you in the comments, okay? I'm going to be asking guys in the comment section. But what have I been telling you guys is really important when it comes to interest rates? What changes every single day? Remember, guys, it's not necessarily the interest rate that is changing. What is changing every single day, you guys? What am I trying to train and preach to you guys as consumers? I want you to learn. Okay, so again, you're going to buy a house, you're shopping your mortgage, you call your loan officer, you say, hey, give me an updated what? What is it called, guys? What is it called? See, I've been really stressed. I've been doing a lot of this type of training in these lives. I will get back to that, but you guys already forget. Come on, man. Where's the comments? What changes every single day with rates? Come on, guys. I see you huddle up. That in pencils? No, guys. Oh my gosh. You guys not know? Someone knows this. Christy, Jeff, what changes every day? No, not Wedge. Not Wedge. Be nice. What changes every single day? What am I telling you to watch out for? Okay. If you guys need to know this, if you're going to keep yourself safe. No. It's my last live, Kim, because I have to move out. I live in a mold rental and I'm forced to leave. So it's hurting my purchasing power. All right. No, guys, how are you guys not getting this? Okay. I'm about to show you, but you guys need to promise me you will not forget this time. What changes every single day and what you guys need to pay attention to as far as consumers is the pricing. Remember, guys, that changes every single day. Okay, it's not necessarily, although right now it's been pretty crazy, It's not necessarily the interest rates. It's the cost or the price of the interest rate, guys, that matters. Okay, so when we're looking at this rate sheet right here, okay, we see the interest rates in this column. Okay, here's your interest rates. Now remember, there's a rebate, okay, there is a discount, and there is a par. So your par rate is the interest rate that cost, basically, that you get for free. So based on these interest rate, guys, and here's the fee column. Okay, so I'm going to circle it right here. So here's your fee column. What interest rate is the closest to par? Okay, at least you guys should know that, right? So you know how to read this form. You guys better know how to read it. You guys, no one said pricing. I'm so sad. But tell me, out of these interest rates, what is the interest rate that is closer to par? All right, is it the 6%? Which one is it, guys? Which one is it? Again, remember, I need you guys strong, because as consumers, I need you to shop your lender properly. And I'm going to pull up a loan estimate, and I'm going to show you guys how to shop here in a minute. And that's a really cool form, but I need us to stay here until we get this, okay? It's not the interest rates, it's the pricing. What rate, guys, is the closest to par? Remember, par is even. Okay, so what's the closest to par? So someone said, look at that. Yes. So Kevin, you win, brother. Congratulations. Thank you for participating. He is 100% right, you guys. The 6.375 is the closest to par. Okay, so 6.35 is right here. And here's the cost. Remember, you guys, interest rates cost money. It increases your closing costs, okay? So that 6.375, you see here that the cost is $713. Now, if I wanted to get an interest rate that was 6%, okay, so if I wanted to get an interest rate that's 6%, how much money would that cost me, guys? How much money? Because we're looking at pricing. You guys are smart. You guys are empowered. You guys are going to teach other people how this works. If I want a 6%, how much do my closing costs go up? Maverick, I want you to get this right, Maverick. I see you. Kim, get this right. Voval, get this right. How much does a 6% cost me? You guys are experts, okay? Trust me, you guys are going to get this. Pay attention to what I'm saying. This will go a long way. I love learning too, Joe, but I want you to participate. I want someone to get this answer right. How much does a 6% cost? Okay, remember, this is going to increase. That's right, brother. You got it. Living in Omaha, thank you for flying in. What kind of cape you wearing today? You wearing your red cape, your blue cape? He's right, you guys. The cost of getting a 6% is right here. So remember, that cost is $9,200. That means my closing costs go up by $9,200. Now, if I want to pay an extra $9,200, remember, you guys, my payment only goes down about $130. Okay, so my payment goes down $130 a month for $9,200. To me, that's not worth it. Generally, I want to get the money back in 5 years, but we're in a crazy housing market right now. It depends on the situation, but I don't think we should be buying rates down right now. Now, what interest rate, okay, and we're going to move on, but what interest rate would I have to take if I want $3,000 back? Okay, so if I want the lender to give me money, remember, that's called a rebate. Say I'm broke. If I'm broke, I'm not going to buy a house, but say I'm broke and I'm going to buy a house. I don't have enough money. I need more money, and I want to get the money from the lender. How do I get $3,000? What interest rate do I have to take to get $3,000 as a rebate? That's right, Cody. Cody got it right. Good job, brother. I see you guys pump me up so much, man. I'm so glad you guys are learning. That's right. We would have to take a 6.625, and the lender would give us a rebate of $3,500. So instead of closing costs increasing, like it would increase $9,000 here, closing costs would now decrease $3,500 because I'm now getting the higher interest rate. Okay, so remember, you guys, I'm sorry that wasn't entertaining. I know a lot of you guys want to be entertained, but I'm going to be teaching you. Okay, just going to get over it. I'm going to be teaching you guys. Now let's get started on the mortgage update. Take a look at this, guys. Here's the 10-year this morning. The 10-year reversed just now. Literally just now. It's been down the entire time. So the 10-year right now, you guys, the 10-year treasury is what is tracking the residential mortgage rates. The federal funds rate, which the Federal Reserve changes, right? Are they going to cut rates? Are they not? Remember, that's not directly impacting mortgage rates. Although it does influence them, it's not impacting them. If you want to look at the trajectory, you got to go 10-year. Right now, again, it's flat, and it's been flat for a long time. Take a look at what this is doing, you guys, to the mortgage rates. They're keeping us in 7%. It's like they're locking us up, not allowing us to go under 7%, which is great news. You guys remember, again, the beginning of this year until last year, I've been telling you guys we need 7% through spring and summer home buying season. If we get that, we get our inventory, we could start the recovery. Guess what has happened? We have our inventory, or at least it's coming back. It's coming back like crazy, and there's still a bunch of people that are on the sideline with golden handcuffs. So there's going to be more buyers and more sellers that come to the market as interest rates get lower. But remember, buyers' purchasing power is getting destroyed. Nevertheless, conventional is sitting at 7.02. 15 year is actually the lowest right now. So 15-year conventional, 6.43. You can see that, this is a rare that this happens, but the 30-year FHA is now higher than your 15-year. VA is also 2 basis points higher than FHA, but generally you're going to have your lowest interest rate with your 30-year mortgage. And generally, if you have the minimum down payment, the FHA is generally the cheaper loan at the beginning. Okay, so generally minimum down payment, 760 or a lower credit score. Generally, FHA is cheaper in the beginning. The disadvantage of right here, which you guys see, the FHA, is the mortgage insurance premium. You have to pay an upfront mortgage insurance premium, and you have to pay a monthly. That never goes away, at least with conventional right here with the higher interest rates. That mortgage insurance will eventually go away. That's generally why most people want conventional right here over FHA, even though conventional has a higher interest rate. Okay, so if you guys take a 7.02, we're going to go to the amortization schedule. You guys know I'm preaching like crazy on these amortization schedules because this is a death contract. If you guys don't want this to be a death, literally mortgage stands for death contract. If you guys don't want this to be a death contract, then you must either not get a mortgage. Jeff, if you're listening, good job. Or if you're going to get a mortgage, you got to pay down your principal, ya guys. If you get a $324,000 loan at today's interest rate of 7.02%, your fees, not the principal, I'm just talking fees, you pay $453,000. If in the first year, you guys, if you pay, let's see, about $3,300 your first year in principal, you guys save $22,000 in interest. Okay, so just remember, take away from these videos how bad the amortization schedule is and how much of an ability you have as a consumer to do something about it, so long as you make a conscious decision with your spouse or whoever to attack that sucker. But please, guys, please don't keep your head in the sand. This is a horrible kind of debt. It will keep you trapped in the system that is designed to take advantage of your bad spending habits. So pay that sucker down and get out of that rat race, okay? So now as far as what's going to happen next, take a look at CME Fed Watch. The market is just completely useless at this point. Let me go to July and let me show you real quick. So the next meeting is obviously July 31st, right? So July 31st, they're still saying there's room for rate cut. So, I mean, I'm just so sick of the market. I'm so sick of the bulls. I'm so sick of them, to be honest with you. But anyways, guys, they're saying there's a 10% chance that there's the first rate cut in July. If we go to the end of the year, you guys know I like looking at December. December's actually changed a bit. They're only saying 5% chance no rate cut, 27 one rate cut, but the majority are saying there's going to be 2 rate cuts in 2024 for a total of 50 basis points. The market's saying a 44.8% chance of that happening. Now, obviously, guys, a lot of us don't agree with that. I'm one of the people that do not agree with that, as you guys know, but that's going to be your mortgage update. Now, what I want to show you guys is let's take a look at something called a loan estimate. And a loan estimate is something that you review as a consumer to shop your mortgage. So remember, you guys, when it comes to shopping your mortgage, I'll show you what this looks like. Okay, so this is what it looks like. When it comes to shopping your mortgage, you have 2 things you got to shop for. You have your interest rate. Okay, we talked about interest rate already. Remember, usually your broker is going to have a better interest rate than a direct lender. But the other thing that we have to talk about are the cost. So there's 2 things, rate and there's cost. Now, again, what you're looking at here is called an LE or loan estimate. In the industry, we just call this LE. Okay, again, It stands for loan estimate. We used to have HUDs or good faith estimates. We no longer have good faith estimates, which were called GFE. It's now an LE. Now, when you first look at this, I mean, look at all the fees. It's overwhelming, but I'm going to tell you guys the only area that you need to look in. Okay, so when you're shopping your mortgage, you don't need to look at this. You don't need to look at this. You don't really need to look at that. All you need to do, guys, if you want to get compare apples to apples, all you have to do is look at Section A. That's it. A lot of people want you confused and they want you to look at all this stuff here, but you don't do that. These fees here are generally, okay, the same, no matter the lender you go with, okay? The thing that fluctuates is Section A, which is what? Loan costs. That's it. So when you're shopping your mortgage, don't let them get you like a mess. Don't, again, put your time and attention on what really matters. It's the pricing of the interest rates plus how much they're charging you. And generally, there's going to be two charges that you want to look out for. It's your loan origination fee. Well, there's actually three, you guys: loan origination fee, processing fee, and underwriting fee. So we can see right away, so right away I see the loan origination fee. Look at this. $5,700. Nope, I'm gone. Goodbye. I'm not gonna go with you. If you're charging me $5,700 in an origination fee, I'm out. The reason I'm gone is because there's multiple brokers that their total of all their fees, processing, underwriting, and origination, is $1,000. That's it, and they're charging $10,000. Look at $10,000. Look at that. Now remember, you guys, part of the reason why that's $10,000 is there's a discount fee right there. You see that? See that first fee, that $2,800 right there? That's the discount fee to do what? To buy the interest rate down. Okay, you got to be careful. A lot of loan officers will sneak that discount fee in there. Okay, they will not, because a lot of times, you guys, buyers are like confused. They're all over the place. So a loan officer will know that you're just shopping your interest rate. So I'll say, hey, I can get you a 6% interest rate, but I'm not going to tell you that it costs 2% to get it. So you got to make sure they are not charging you for the interest rate. The way you know that is not only your pricing sheet that I showed you, but you look at that loan estimate again, and you look at that section and only that section. Okay, that's it. Section A. Okay, just look at Section A. So that's that. Now let me give you one more thing to shop, okay, which is your homeowner's insurance. This is what you have to be very careful. And now you guys remember, I didn't want to rent. I wanted to find a house. I put an offer on a house. My goal is to have 30 to 35% of equity when I move in. The house that I found, I put a verbal offer in. It was at 21%. Okay, so I found a home at 21% of equity, but I walked away because before I put my earnest money down and I started spending money, I shopped my insurance. I live in Texas. If you're a home buyer and you're shopping right now, I'm gonna tell you guys, talk to your realtor, but before you start spending money, run your freaking insurance, because it may blow out the deal out of the water. And that's exactly what happened to me. But before I go into that, let me show you this policy. So first of all, what I want to show you guys, and I've highlighted the dwelling coverage. You have to be careful here because a lot of times they will have too high of a dwelling coverage. For example, this policy right here is on a house that costs $400,000. So the person that came up with this insurance plan is charging too much. Okay, the dwelling is too high. The dwelling coverage only needs to be $400,000. If that dwelling coverage was $400,000 instead of $600,000, my total premium would be lower. So you guys can see my total premium is $2,375. But there's an additional error. So I have one error, which is the dwelling coverage. But look at this, guys. You got to be so careful. It's your deductibles. You have to be careful on your deductibles. Now, this is Texas. Take a look at my deductibles. All right, look at this. My deductibles are right here, 5 and 5. That's an insurance policy that's not going to help me if anything happens. So again, if you're just sold on that payment, remember, everyone's sold on payment. Oh, we need a low payment. We need a low payment. We don't care how the payment's calculated. Wrong. You do care about how the payment's calculated, okay? So the only way that this insurance provider was able to get that lower premium is they screwed me on my deductibles. What it should be, guys, is 1%. and 1%. But instead of 1% and 1%, it's 5% and 5%, which means my deductible is $30,000. Some roof repair, for example, costs less than $30,000. So it costs me the same it would cost a brand new roof. So my point is, guys, is this insurance policy for me is a complete waste. And I also want to put this in perspective. Okay. So again, on a $600,000 dwelling, look at it's $2,300 a month, although that's 5 and 5. Now, the home that I walked away from was a $340,000 house. Okay. And I remember I ran my insurance before spending money on my earnest money and my option fee. And the insurance was, you guys ready for this? And this is a $340,000 house. My yearly premium came out to be $5,800 a year on $340K. So I did something called, okay, a lot of people don't know what this means, but I did something called walked away, because $5,800 a year for insurance on a $340,000 house is psycho, and I'm not going to do it. It killed my cash flow, absolutely destroyed my cash flow. So, I mean, it is what it is. Okay, but that's that little fancy stuff. Okay, so now what we're going to do, guys, I hope you liked it. That was our mortgage update. Had some little fancy stuff. Let me know. Comment below. Let me know if you like. I see you guys. You guys making fun of me? I'm looking at the comment section now. You guys making fun of me? That's all right. I love you guys regardless. Now, our first video, let me tee this up. Okay, my first video, this is a good one. Okay, this is going to go into how the Fed is using lagging data. And the question is because the Federal Reserve is using lagging data, is that a higher likelihood that we're going to go into a deep recession because they're using lagging data? I don't know. Is that what that means? All right, guys. And if you can, let me know that the audio is okay. Let me make this a little bit bigger. Please let me know that the audio is okay. Boom. Okay. And comment.
The Fed has been on hold with rates for almost a year now. They've implicitly suggested they feel as if the cost of patience is pretty low in terms of how the economy is performing. I guess you're arguing that seems to be changing right now.
Absolutely. The Federal Reserve has looked to a strength in the labor market, strengthen the overall economy, is giving them the luxury of time to get more data. We'd all like more data to know that things are going better. Unfortunately, over that period of time, the labor market's moderated. The economy is moderated. They don't have that same place of strength, and they are not changing their story and their logic, which in a risk management sense should raise some real eyebrows. The world is changing, and the Fed seems very much stuck in this backward-looking, data-dependent mode, even as we get good data.
Yeah, I guess you're saying that risks are rising. That I suppose that the weakness in the labor market will reach that threshold that you focus on that suggests that it's further upside from there. In other words, just saying, oh, we have a structurally tight labor market and unemployment is only 4% is not much of a comfort.
Correct. And really, the argument at its core to begin cutting rates is that we have made a substantial progress towards the 2% target. Right? We are talking about a first rate cut, a gradual cut, a managed cut. The Fed has amped up the bar on this to a place that, frankly, it is of itself risky in the way it's tying it to data and thinking so hard about this first rate cut. I'm not suggesting they go out and cut rates by 200 basis points at the next meeting. Right? We're not there yet in terms of the target, but we are well on our way. And the Fed has a dual mandate, and it needs to balance the two.
Claudia, how much are you paying attention to the neutral rate? That's the theoretical level where borrowing costs neither stimulate nor slow the economy, because there's a school of thought that believes that it's actually much higher. So ultimately, if and when the economy does slow, does that mean we should expect fewer rate cuts than we're used to over the last few economic cycles?
We need to focus on the immediate decisions. Right. So as I said, I don't want to make any pre-commitments. You start 25 basis points every other meeting. You do 200 basis points. Like, it would be absolutely inappropriate. We just don't know enough for the Fed to be making those kind of decisions right now. Those kind of like, let's think about the whole suite, like everything we're going to do from here until stopping. You would need to know the neutral rate to do that. Right. We don't know that. And we can comfortably say, looking at credit stresses on households that deal with needed debt, that we are well from a neutral place where the Fed is having no effect on the federal funds rate. So no effect on the economy. So we don't need to have that neutral rate discussion right now. We need to have the discussion about where we headed the next year, the next 2 years, just in terms of how the inflation and the interest rates evolve. And I think the long run is maybe less informative than people would like to have that discussion be.
Yeah, it always was obviously kind of a vaporous sort of concept in terms of the neutral rate. Although I do wonder what you'd be looking for right in the near term here. Steve was talking about the focus on weekly unemployment claims. And I guess you're suggesting that, essentially there's not much chance we reaccelerate on the inflation side. So what are you most acutely focused on in terms
What about
of
the deficit
deciding
spending?
whether the economy is just decelerating to a normal sustainable rate or perhaps weakening to beyond the point we'd like?
I absolutely agree with Steve that I should be on the labor market in terms of the risk to the other side. And here, unemployment insurance claims, looking at unemployment, the unemployment rate, not the level. It is very low, but it has drifted up. And that can often be a sign that we are moving towards,
recession.
and sometimes that's when we're in the recession. The turning points in the labor market can be pretty subtle. We need to pay attention because once that goes, you break that very virtuous cycle between the consumer and the worker that we have benefited from in this recovery and should keep going into the expansion. So you're looking for some pretty subtle clues. It's maybe not surprising that the labor market has been very hard to read in terms of its strength or its weakness, but pay attention to the changes, right? Where things start to fall off of what have been some very strong readings.
I think she did a good job. What do you guys think? So they need substantial progress for them to stop. And another, way to say substantial progress, I think, is deflation, right? Some type of collapse. But I mean, I was refreshed to listen to her. I was like, wow, why don't we just keep listening to her? Did you guys like what she had to say? Let me know whether or not you liked it. I'm going to throw up a couple comments. You guys, a lot of people are talking about the insurance. Terry, it's always good to shop insurance every 1 to 2 years. Insurance game is cray cray. Here's what I wanted to say about what Terry's saying. You guys should shop it every year. Now, generally what happens is in your mortgage, you have to set up an escrow account and your lender is required to pay your insurance. However, even if that's the case, you still have the ability as the mortgage holder to shop your insurance before it's due. So again, I would do that every single year because what happens a lot of times is the insurance companies get comfortable and they charge you more money the next year and they don't even tell you. They like to sneak it under the radar. So make sure you're holding them accountable. Great point, Terry. Okay, here's another one. It's whatever you set it. It's not always 1%. And that's exactly what I was trying to make. The point I was trying to make, Elver. A lot of times the way to get your insurance premium lower is by increasing the deductibles, kind of like really any insurance on the history of planet Earth. But yeah, you have the ability to change that. But remember, you guys, I suggest 1, maybe max 2% deductible. This is Texas. Texas is expensive. But 5%, Elver, let me know if you agree that 5%, that's just crazy. 5% is crazy. Let me know if you agree, Elver. Maybe you do, maybe you don't, but it's a little bit of a risk, okay? So here's a comment from P Nice. What's the best resource to find out pre-insurance? A lot of times, okay, so generally, a citizen consumer is going to go to their realtor to get referrals. But I'll tell you guys now, generally the insurance referrals, the best referrals come from the loan officer because it's the loan officer's job to order the insurance for the loan. So again, either your realtor or your loan officer should know, but generally the person with the biggest power, best resources for insurance is your loan officer. So try a loan officer. Okay, got a couple more comments. Really good comments, guys. Get an independent insurance agent. They will shop every year for you. And that's exactly right. And see, that's Adam. And that's Adam. He's a realtor. And he's right. But the problem is most insurance people will not do that. The good ones will, but most won't. Most are just going to renew your policy. Because remember, you guys, they are automatically paid from your lender. So they don't have to call you. They just keep renewing it a lot of times. So just, again, hold them accountable. Okay, another, here we go. What kind of crap box were you buying for $5,800 a year for home insurance is stupid high? And I'm going to tell you exactly. So it was actually a nice house. It was built in the year 2000, I think. So it's fairly new house. But what I noticed, oh, this is Elver as well. That's funny. But what I noticed, Elver, is the roof was 24 years old. So obviously, like, I'm forced out, like I'm a mess, right? So I'm like negotiating, and then I'm like, oh my God, wait a minute. The roof is 24 years old. Maybe I should get an insurance quote, right? So thank God I did, because that roof is on its last leg. And because the roof was so old, 24 years old, they hit me bad. Generally, for insurance, if your roof is 10 years or more old, you're going to get hit bad on that insurance premium generally. So, and then the last thing here, guys, and I'm going to get started on our next thing, which is really cool. Scrog, you already know what I'm going to ask you. What am I going to ask you, Scrog? I ask you every time I see you because I care about your well-being. Do you care about my well-being? I think you do. What am I going to ask you, Scrog? What am I going to ask you? I want to see in the comment section. What am I going to ask you, Scrog? You already know, man. What am I going to be asking you, Scrog? What am I going to ask Scrog? Who knows? Who knows what I'm going to ask Scrog? Anyone know? What do I always ask Scrog in the Discord? Anytime I see him, because Scrog just bought, and he just bought in Texas. What do I always ask you, Scrog? What am I always asking you? Let's see if he gets it. Let's see if he gets it. I want him to get it. Okay, let me come. Scrog, where you at, Scrog? He called you, Scrog? That's right. All right. So as we're waiting on Scrog to see if he gets it, I wanted to remind you guys this. So we're going to go into our real estate part of the video right now, and I'm going to show you guys some pretty cool stuff as well. Where's Scrog at? Where are you at, Scrog? Where are you at? No, not his wedge, not his wedge. I always ask Scrog one thing. Okay, I say, as soon as you move in, this is what you should do. As soon as you move in, this is what you should do. What is it? I'm going to give you another chance, Scrog. He may not be on right now. Anyways, guys, so we're going to go on to the real estate section. I wanted to remind each and every one of you that I made this really easy to use form. Really, guys, what you need to do is all you need to do is figure out what your price per square foot is for the market and price per square foot for the rental market. Now, remember, this form is free. I made this form for you, and it's sponsored. Look at by the Logan Trading Company. This is Johnny Fly's company. If you guys want to support, our community, if you want to support Johnny, go to his website. Okay, LoganTradingCompany.com. He sponsored this. He's a member of the community. I always love to see people fly, that are a part of our community. Of course, where's Scrog? Did Scrog answer yet? Where's Scrog? Scrog didn't answer yet. Dang, Scrog, where you at, bro? Anyways, guys, so remember, this is linked in every one of my descriptions. Use this form because this form is designed to help you guys figure out what the wedge is and what the cash flow is. Now, I'm not going to show you how to use it on this live. When I make my school, which I plan on doing next month, I will be doing these a lot more. So I'll be doing them through a school that I create. But regardless, guys, what I'm trying to explain to you is it's there and it's for free and you guys probably should use it. Now, here's what I like to do. And if you're a realtor or even a consumer, you may want to do something like this. Where's Scrog? There he is. There he is. Scrog, there you are. Yeah, we know. Oh, yeah, here it is. Homestead. Yes, he got it right, guys. You see how much I try? I really do love you guys. I really do love you guys, man. I'm here for you. I feel like this is my purpose. Scrog is right. I've been always hitting him up. As soon as you close, you file your homestead because you got to take advantage of tax savings immediately. Thank you, Scrog. But did you do it, Scrog? No, Scrog didn't do it. He didn't do it. I don't think he did it. But anyways, guys, so remember this, okay? Let me show you this again. Now, if I'm a realtor or if I'm in an area and I want to buy a house, this is what I'm doing, okay? What I've done is I've taken a screenshot of a map, hypothetically, of the area that I want to purchase in. And Adam, I want you to do this. I want you to do this today, Adam. And if you're a realtor, I want you guys to do this today because you will help a lot of people and you don't have to get caught up in all the crap. Now, what I did, here's a screenshot of the Kingwood City. And what I have done is I have circled the subdivisions. So each of those little circles is a subdivision. And also on top of etching out subdivisions, I've put how much price per square foot the average home sold for over the last year. Okay, this allows us to just be absolute studs. This means that any listing that comes up in Kingwood, I can immediately look at that listing, find out the subdivision, and I immediately know what the price per square foot is. Why is that important? Because I want to figure out wedge and I want to figure out my cash flow. Do y'all understand? So again, if a home comes on the market and it's in the market in this subdivision, okay, and that home is listed for $120 a square foot, okay, in this subdivision, how much under market is that being sold for? This is the point. This is what I want you guys to be good at. Okay, so again, I found a listing in the subdivision. Okay, the average home sold for $143 a year, over a year. The new listing is on the market for $120 a square foot. How much wedge do I have per square foot? How much wedge do I have per square foot, guys? How much value? I need you guys to tell me how much. Okay, so again, the listing's is being sold under market value for $120. The average home sold for, it is different when it's rural, Cody, yes, but the average home sold for 143. I need someone to get this. Adam, if you can't do simple math, you better quit. Quit real estate right now. Adam, I need it to be you. Adam, I need this to be you. How much wedge do I have per square foot? Adam, you're the realtor here, brother. You got the license. Where you at, Adam? I swear, Adam, you should be able to do this in your head. How much wedge do I have per square foot? Jeff, tell him what's up, Jeff. Just come in for Adam, Jeff. There it is. Here we go. We got him. Boom. $23. That's right. Because remember, the listing is, so a home is being sold for $120 a square foot. But we know over the last year, homes sold for $143 a square foot, which means the difference in those two numbers is $23. Okay, so if the home is 1,000 square feet, how much wedge do I have? Okay, so the home is 1,000 square feet. That's the size of the home. How much wedge do I have? Okay, you guys got the $23. Yes, we know it's $23 a square foot. Okay, so the wedge is $23 a square foot. My home is 1,000 square feet. How much wedge does that give me? You guys think that I'm going to go on to the next thing. I ain't going to go on to the next thing. I told you I want y'all to learn. Boom, Ken got it. That's right, Ken. Because you guys, it's simple math. That's right. Ken got it. It's $23,000. You guys, I can find homes pretty much all day in my local housing market where I have the wedge now. The problem in Texas, though, is yes, I have the wedge, but the cash flow is absolutely despicable right now. But I want to remind you guys, again, I'm trying to do a little extravaganza. I want to remind you guys how value works, okay? Median is trash, okay? Median is not value, and Case-Shiller is a value index. Zillow is a value index, but they're also trash. You guys got to look up comps. That's why I gave you that information before. Now, the reason we do it like that is because that's how appraisals work, okay? What you're looking at right here is you're looking at an appraisal. I used to teach on appraisals. I love appraisals. Okay, now what I've done, guys, is the yellow column is our subject property. Okay, let me zoom into this. Maybe, can I zoom in? Yeah. Okay, so the yellow is our subject property, and the red columns are our comps. Okay, whoops. So you guys can see here. So sorry, guys. It wants to be mean to me today. Let me go up here. Okay. So you guys can see that we have 3 comps. That's why I'm constantly telling you guys, if we have 3 bad sales in a subdivision, it can ruin the entire subdivision, because the way that appraisals work, they're only looking at 3 comparables. Now, obviously, guys, what they do is they compare characteristics. For example, you see these little green stars I put right here? See those green stars? I did that because generally, not always, okay, there's special characteristics. Understand what I'm saying? Not always. But generally, you want to look for properties that are the closest to size. And generally, the way that I'm running my market analysis, 500 square foot variance. You guys can see our subject property. Let me try to zoom in. If you can't see it, I'll just tell you guys. Our subject property is about 2,900 square feet. Okay, so we have a 2,900 square foot subject property. Our first comp is 3,100 square feet. You guys can see that right there. So our first comp is 3,100 square feet. That is within 500 square feet. Second comp is 3,368. That's within 500 square feet. Last comp is 2,900 square feet. Now, adjustments are made based on characteristics. And on the bottom, they calculate your net value. You guys can see 389, 342, and 348. All right, so generally what an appraisal will do is they'll add those together, divide by 3, and they'll get a value. But in this case, they did not do that. In this case, the appraiser was lazy, and they gave this appraisal a value of $348,000. The reason I'm saying they're lazy is they could have got a lot more value for this house. They chose not to. And I believe, because I see this all the time, the reason why they didn't go aggressive is because, look at this. The appraiser knows the sales price, and is generally, as soon as they meet that sales price, they stop. And honestly, that's, in my opinion, that's against the law. In my opinion, it's against the law. You can't stop. If you hit your price, you can't stop. You got to do an unbiased appraisal, and they don't. And the reason I show you guys that is because it's just like everything I'm showing you. It's simple math, and not only is it simple math. I mean, some of these appraisers are horrible, especially when it comes to refinance. Now, what I just showed you guys works the same ways if you're going to protest your assessed value. But if you're going to protest your assessed value, obviously you're going to want to use bad comps. Now, let me see real quick. I wanted to show you guys this quick update. Boom. All right, so we're still on our real estate section. This came out this morning, June 25th, a big picture of the housing market. I just want to give you guys this last thing about the housing market, then we'll move on to our video. Very interesting. So this came out from the Center for Housing Studies at Harvard University. And again, this came out this morning. So this is Harvard. In another article coming out this morning, this is what it's saying. Both renters and home buyers are suffering. So even though, it's never been a better time to rent compared to buy, it's still horrible. It's still so expensive. With only 1 in 7, so 1 in 7 renter households being able to afford the cost of their first home, which is saying that ain't no one can afford a house right now. Home prices hit an all-time high in the early months of 2024, with prices rising in 97 out of 100 biggest metro areas. Now, home insurance premiums also went up, shocking, in 1 year, 21%. That kills people on fixed income, by the way, while property taxes are increasing and mortgage rates remain close to their 2-decade peak. Rising insurance costs are driving up housing costs around the country. That's why I walked away from that last house, so I can testify. I showed you guys that, particularly in states like California and Florida that are hard hit by climate disasters. The fact that they didn't put Texas on here blows my mind. Why didn't they put Texas on there? I feel like they're discriminating against me or something. There is some news that's more positive. This is crazy. Listen to this, guys. Nearly 450,000 new apartments were finished in 2023. That's the highest rate in about 3 decades, and it should be even more. This year. So, inventory skyrocketing. Pretty sure we all know that by now. All right, let me tee up our second video. A lot of good stuff from the Fed speakers. Second video, it may seem obvious, but it's refreshing to hear the Fed acknowledge that we need purchasing power to go down more. So this is going to go into kind of purchasing power needing, and demand needing to go down. Let me know that the audio is good. Thank you, guys.
Steve Leisman with those headlines. Steve?
Yeah, good afternoon, Kelly. Fed San Francisco President Mary Daly saying the economy is closer to a point where the benign outcome could be less likely. So she's the second person today, second Fed official to worry about possible weakness in the economy. She goes on to say inflation is not the only risk we face. And then she offers 2 different scenarios, which are not perhaps surprising to our viewers. She says the Fed can stay higher for longer if inflation falls more slowly than expected, but lower rates would be necessary if inflation falls more rapidly or the labor market softens more than expected, very much using a construction used by the Fed chair, Jay Powell. She goes on to say the Fed is still fighting to bring inflation to 2%. So here's the normal talk about still fighting inflation, saying we've made progress on inflation, still more work to do. Goes on to say the rise in unemployment so far has been modest when you look at the decline in inflation, and she's not yet confident enough to cut rates because of the bumpiness of the recent inflation data. And she says it's hard to know if we're on track for price stability. One other thing which is interesting, she says restrained demand is now needed to get inflation down. So Tyler, another Fed official who's the idea of working in this idea that there is some weakness they're concerned about, but not yet definitively offering new guidance about how monetary policy would respond to that change in in the outlook.
Interesting that last point you made there. Restrained demand is going to be a key part of getting inflation under control. That sounds like we've got to have a slower economy with higher unemployment.
Duh.
You know, I put that in there, Tyler, because it was a little bit perplexing to me in the sense that she's at the top of the remarks. We noted she's concerned about a weakening economy. At the end there, we talked about how she's saying, well, look, we need a weaker economy to get inflation down. So I'm not exactly sure what maybe the reaction function is of the Fed here to weakness. Would they cut rates or would they welcome a slower economy?
Yeah, exactly.
I think they're welcoming the slower economy. What do you guys think? So a couple good comments here, and then we're going to go into our liquidity and recessionary indicators. But Scrog, here's what Scrog is saying, back to the kind of the protesting of value. If anything, protesting may possibly hurt us as far as tax liability goes. Wrong, because you're protesting. And I understand why you're saying that. And this is what I want to warn you about. Never submit a comp, Scrog, that supports the value that they want. If you can only find one comp that helps your case, then only send in one comp. The mistake that people make is they feel like they have to send in like 3 or 5 comps. And so they find maybe 2 good comps and then the rest of the comps are bad comps. Never send a bad comps. You help them do their job. So remember, Scrog, don't ever send a comp in that is showing their house is worth more than it actually is. I know that's hard because you're not a realtor, but you kind of get through learning how that works. So it should not hurt you. In fact, that most of the time they give you an automatic decrease when you protest just for putting in the effort. At least that's from my experience. Okay, so Trey is 100% right. Inventory is absolutely skyrocketing, especially in Tennessee. But here's the problem, guys. It's still overpriced. We have not had a nationwide price correction yet. We started to have that mid 2022 into the beginning of 2023, but that reversed. So again, all signs that I'm looking at least tell me that 2024 is going to be the same as 2022. However, 2025 is not going to be like 2023. That's my opinion, of course. But yeah, Trey, them craps is overpriced like bad. Now, I am the plunge protection, cute jogging suit. So you got to, is that Biden? Oh my God, I'm not going to go there. You almost got me in a trap, brother. You almost trapped me. Okay, but and he's wrong about this, but he's got a good point as well. But wedge means absolutely nothing as price crater. Actually, brother, in my opinion, it means even more. Your wedge means even more when price crater. It's the opposite of what you're saying. But his point is, and he has a valid point. So say I purchase a house that has 20% of wedge, but home prices go down 30%. So 20% in wedge, but home prices go down 30%. That means that I lost 10%, right? I'm upside down 10%. But the reason why wedge matters, like even more right now, is so that you have cushion, right? If I just bought at market peak and home prices go down 30%, guess what? I'm upside down 30%. But if I purchased a house that has, again, 20% in wedge, home prices go down 30%, well, then now I'm only down 10% now. You guys, yes, if prices go down, you will lose your wedge. That's why it's so important to have it. You don't want to be like upside down 30% if you can be upside down 10%. It's still bad. I'm not saying it's being upside down is still horrible, but wedge matters, and it matters a lot, especially in times of turmoil, because it gives you a buffer. It gives you a buffer and it gives you a cushion. But he's not wrong. He's not wrong. And that's why I'm doing minimum down payment. I'm not doing 20% down payment to avoid, mortgage insurance, because I expect values to go down as well. But I appreciate that comment, sir. Here's one from Terry. I understand the price per square foot method, but I'm not sold solely on price per square foot. Good. You shouldn't be. So, and I'm pulling this comment up just to reiterate what he's saying. Price per square foot is just the start. Price per square foot and I say this all the time, it allows us to review. I can review 10,000 comps. And pretty much within 20 minutes, I can find wedge in 20 minutes because price per square foot method. But there are additional things that matter, like the comps, the condition of the property, the location, subdivision, landscaping, utilities, kitchen, much more that goes on. But I'll tell you right now, price per square foot is going to do a lot of that lifting for you. But like he's saying, a lot more needs to be involved, like driving around the neighborhood. I think that's a huge thing, driving around the neighborhood. Anyways, I don't know if you guys agree. All right, so let's minimize this real quick, and then we're going to get started on our liquidity. Here we go. We're going to start on our liquidity and recessionary indicators right now. Let me put our timestamp right here. All right. This is where I want to start. Okay, so we're going to first start we're going to talk about the reason I do recession and liquidity in the same segment is we're not in recession yet because of the inflation, because of liquidity, in my opinion. So let's start with recessionary indicators. And one of the biggest indicators right now is what I believe is right here. Now, what you guys are looking at is the unemployment rate. Okay, and the reason why I'm showing you this is unemployment doesn't go up. The only time unemployment goes up is if we're headed to recession. And again, unemployment doesn't go up. Generally, anytime unemployment goes up, it's followed by a recession. Now, I've marked times where unemployment have gone up in red. And then I've marked in yellow when we enter recession. And look at guys, I'm going back to the 1970s, okay? Look at unemployment went up right here. We went into recession. Unemployment went up right here. We went into recession. That's 1975. That's 1980, 1990. Unemployment went up. We went into recession. 2000s. Unemployment went up. We went into recession. GFC. Unemployment went up. We went into recession. Right now, unemployment went up. What happens next? What happens next, guys? Okay. What happens next, guys? You got to look at the trajectory. And we already know they're going to revise the data, right? I mean, they're probably going to revise the data, but let's go now into a couple other things. Here is another recession indicator. Okay. You don't have to believe me. You don't have to believe the bears or the bulls. There is one set of data that takes a lot of things into consideration. What you're looking at here is one of the most trusted single sets of data that spells out a recession. This is showing us how many people are betting against the Fed and think that the market is going into recession. Literally, this is saying, hey, we don't care what's in the headlines. The market's going into recession. We have been inverted for the longest inversion in history. We are 46 basis points inverted, which is basically, guys, we're the deepest inverted since December in 6 months. We're stuck in inversion. But again, you guys, this is the warning right here that there's no guessing. We don't have to put our emotions into this. This is what is happening. This is a warning. This is the 10 and 2 yield curve inversion. It is screaming recession, just like the trajectory of unemployment. So we have unemployment trajectory and we have yield curve inversion. And take a look at this. The deficit spending just updated. Healthy economies do not have deficit spending so far. This is so crazy. So far this year, the year starts October. It's a fiscal year. We've spent in deficit 1.2 trillion. We've spent, the reason we're not in recession yet is what you're looking at on the screen. People are, Travis, you're wrong. Yeah, you know what? Honestly, I didn't think that they would bail out banks at the speed of light, and I didn't think they would be running a deficit like this. So it makes sense that things are still being kicked down the road and people are still in overwhelming pain without prices dropping overall. Look at that. How can prices drop when they're kicking in 1.2 trillion? This isn't healthy. And to put it in perspective, during the GFC, does anyone know what the deficit was during 2009 GFC? Anyone in the comment section? I'm going to tell you guys, 1.4 trillion. During the worst recession of my lifetime, the deficit spending was 1.4. Right now, year to date, it's 1.2. And we are supposed to be in a thriving economy with a strong labor market. Everything is fine. Don't worry. Just buy things. Yet we have the elephant in the room right here. When you remove this elephant in the room, everything comes crashing down. 1.2 trillion, and the year is not even up. The economy is a freaking disaster. Anyways, guys, but here's the problem. Let's look at the liquidity now. Let's look at that. Okay, here is the reverse repo market. This is where the banks are putting their overnight money. This is kind of like excess money. You know how consumers have excess savings? That's gone. So now here's the excess money in the institutions. It's stuck. It has been stuck for a considerable amount of time. It's just mind-boggling, you guys. We've been stuck since about what? March? So we've been stuck here for about 3 months, which to me is saying rates need to be higher. I mean, because the inflation is so much, because the deficit spending is so much, it needs to be higher. It's not effectively combating that. But regardless, there's still a ton of money in the overnight repo market. Here's the good news, guys. Mortgage-backed securities. So at least the Federal Reserve is still selling mortgage-backed securities. Now, I'm going to say this is probably the biggest reason we're in this situation. It's not necessarily the low interest rates, because right here where I'm circling, interest rates were 0% basically. So the federal funds rate was basically 0% right here. Did y'all know that? Now, I want to remind you guys that in about 2018, they were doing quantitative tightening. Did y'all know that? In 2018, to right before the lockdown, they were doing quantitative tightening to try to stop the bubble. The bubble. We already had a bubble before this bubble. We have a dual bubble. Look it. I don't have to guess. They're legit quantitative tightening. See? Look at this. Quantitative tightening. Boom, 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 right up until lockdowns. And oh, crap, we messed up. This is a dual bubble. We're fighting a bubble within a bubble right now. Do y'all get it? Do y'all see that? And the federal funds rate also went up this time. You guys, I'm just at the point where, how could anyone say that the economy is strong? How could anyone say that? I just don't get it. And believe it, So anyways, guys, we're going to go into housing inventory. We're going to do our last video right now. I'm going to miss this studio, guys. I'm going to miss this studio. This is where it all started. I'm going to miss this so much. I'm going to go right here. Yeah, I'm going to miss this. All right, you guys, if you can, actually, let me do it like this. Let me know that the audio is okay. This is on housing inventory, basically exploding. Hope you guys enjoy. And again, I'm going to miss it.
Joining us for a closer look today, Ryan McAvenny, Managing Director of Mortgage and Real Estate Services at Zelman & Associates. It's great to have you, Ryan. Are we starting to chip away at this thing?
I think so, Carl. Thank you for having me on. As you mentioned, the data today was down a bit from last month. We've seen 3 months in a row of slowing. So we would say that the spring selling season, the heart of the time when most buyers are active, was a bit disappointing this year. The good news is inventory is slowly building up. We've seen it month after month. You're now inflecting on a year-over-year basis. It's across the board nationally. It's across many of the most important housing markets. History would suggest more listings eventually translate to more sales. In the here and now, the challenge is affordability. It's still high mortgage rates. So there are definitely headwinds. But if there is an optimistic point in the report, it would be on the inventory side coming back to the market.
We've been asking everybody what they think the magic number is on the 30-year fixed. We keep hearing 6.5 to maybe 6 3/4, kind of an area we got a taste of not long ago. We just couldn't last long enough, right?
Yeah, I think directionally that's correct, Carl. If we even look back a few months when we saw a pretty good existing home sale print in February, that was around the time that mortgage rates had dropped to 6.5, 6.6. Call it roughly 5-10% better than where we are today from a sales pace. If we go back a year ago, the first half of 23, similar dynamic. Mortgage rates were in the 6.3, 6.4, 6.5 range. The pace of sales was 5-10% better than where we are today. So I do think as we move lower, hopefully in that direction of a 6.5% mortgage rate, that will unlock a bit more activity. A very notable point that I think will be useful for the audience, every 25 basis point move in mortgage rates equates to about a 3% reduction in monthly payment. So if we're talking about mortgage rates going down 50 basis points, maybe someday 100 basis points, that's a 5 to 10% reduction in price on a monthly basis. And that can help on the affordability side of things for those who are stuck today.
But with lower mortgage rates, do you also get higher home prices? I know we've seen this odd dynamic whereby supply is so tight, so housing prices have remained higher as well. But if rates do start to go down to a more significant magnitude, does that also put pressure, more upward pressure on the home prices themselves?
Yeah, thanks, Leslie. I do think that's the case. Generally speaking, lower mortgage rates, more demand. We should see pricing continue to move higher. The big caveat there is the pace of growth. I do think we've entered a period where the rate of home price growth moving forward is likely to lessen. We go back to those supply dynamics. Nationally, it's up in effectively every major housing market. And we're talking 30%, 50%, 80% higher. When you have that much available to the consumer, albeit coming from very low levels, it should translate to a bit of a plateauing in price. We're starting to see that happen in more markets. So I would not expect significant price growth. I also would not expect significant price declines.
But have you been encouraged, so to speak, by the percentage of listings that have had at least one cut? Are buyers maybe they're not running away with the ball anymore?
Yes, the share of listings with a price cut is certainly going up. Even when we look at the new home market, the incentives provided by builders are increasing and most aggressive in those areas where there is the most inventory. So there is a direct connection between the supply coming to market and how much pricing power there can be had. Buyers are they're able to be a bit more choosy in today's market, whether it's the new side of things, the existing side of things. There is more choice. That's good for the typical buyer, less pressure, less multiple bid situations. But again, if we move into a regime where mortgage rates are meaningfully lower, that competition would be likely to pick back up.
All right, guys. So we get more options, but still pretty unaffordable, obviously. So a couple things here. I'm going to get you guys out of here. You've joined for about an hour. I really appreciate it. Again, man, I'm going to miss this studio so much, guys. Everything happened here. Without you guys, I mean, I couldn't have done this. I can't. We have 100,000 subscribers. I haven't even been to post yet. I don't. It's hard for me to know what to say because it's just such a powerful moment. So I'm just kind of at a last for words. But I'm going to make the post. I just thank you guys. I've grown. Hopefully, I've grown a lot by doing this. Again, say goodbye to the studio. You know, hopefully by Friday, I'm going to do another live and you guys will like the new studio. I'm going to try really hard and work really hard to get everything set up for Friday so I can show you guys my new scene. But dang, it's been a journey and I just really appreciate you guys. A couple comments I want to throw up here. I understand the price. Okay, yeah, we talked about this already. Okay, let's see. Dean right here, worst economy of my lifetime. I'm the same, Dean. And that's saying something because remember in the GFC, I lost everything. I had a foreclosure, a bankruptcy, bankruptcy. What else? A repo. And as a result of my foreclosure, there was a deficiency notice sent to the IRS. I had a tax lien, 6-figure tax lien, followed me around for 9 years because of my bad decisions last time and my desire to keep my head in the sand. Back in the day, guys, I wanted to keep my head in the sand because I wanted to stay in the bubble that I was sold. And that was my decision again. All right, here's a comment from CD Weber. I have protested our property taxes for the past 4 years when property values here in Texas shoot up, not in line with previous increases. And this is the point I was trying to make. My average protest a year is $18,000. And that's what I mean. Even if CD doesn't have comps, generally the county will reduce your assessed value just for making that step, right? So you protest, usually they're going to give you a little bit. And I appreciate you speaking up, CD, on that. So Scrog, that's to you, Scrog. You better follow your homestead, brother. Houses in Northern VA are still selling, but instead of being on the market one day, they're on the market for 2 weeks. Now, the reason I'm bringing that comment up is I don't want to create division. I know I yell at realtors a lot, guys. I think you can understand why. I mean, it's a tough love maybe situation, but every market's different. And so if you see in the comments that and I'm trying as well, I need to get back on the comment section, but I'm trying to be more understanding to people because I believe the elite want us to be divided. And every housing market is different. So there's, like where Todd lives, his housing market, there's still bidding wars. In my housing market, it's like falling apart. But in my market that's falling apart, there are still some subdivisions bidding wars. And then in Todd's market that is like super hot, there's still some subdivisions where homes are sitting. And that's why if you guys aren't empowering yourself, if you're not getting hyper local, then you really don't know what's going on. And here's where I want to end. And I think I've pulled up everyone's comments here. This is where I want to end, guys. If we're on the sideline, even if we're not on this, even if you're Jeff and you already own a home, what we should be doing right now is increasing our purchasing power. And one of the most difficult things right now to increase when it does come to purchasing power is savings. Savings right now is very, very difficult. And therefore, that's the biggest thing, guys. Save, and try to put yourself in a situation to where you can save. Because if we can't save money, then we are living paycheck to paycheck. Okay. So save your money. That's how I want to end. Don't forget, I have the home buyers course and wish me luck, you guys. I have to get out of here. I'm going to start moving. It's been a very difficult last week. Obviously, everyone's sick. We did an air quality test just to make sure, because if it's black mold, obviously it's in the air, it's going to be on my clothes. So I'll have to wash my clothes in vinegar. It's just crazy, man. My purchasing power is taking a hit, but I'm not going to quit, and I'm not going to quit on you guys. All right, guys, I really hope you guys found value here. I appreciate each and every one of you. Please make me proud. Please, again, remember pricing with interest rates for loan estimates. It's Section A. Appraisal, 3 comps, price per square foot is great, but more research needs to be done. And the biggest thing of all, love yourself. Love yourself and love the people in your life. Now, other than that, guys, if you're out there investing in real estate, you guys already know. I wish you luck. Please wish me luck, because I got to move now, and I hope we all win.